Hey guys, welcome back. In today's video, we're going to be talking about if the bull run has ended. Let's dive right into it. Now, here is an S&P 500 index chart. You can see that it has going up tremendously. In fact, it has been going up linearly and it has reached at its all-time high of 5,464 points. Now, this may look like the market is doing very well, but a few key statistics that I found that things are actually not doing very good. Now, let's check it out. The first thing is that you notice the US investors, this is an article by The Edge, and also some of the funds has been deploying their cash holding into equities. Now, if you look at the right-hand side, right, you notice that the average cash level, which is under their asset under management, is actually at its all-time low. Right now, it is about like 4%. If you notice in October 2022, April 20, those are the time when the market is actually facing a bearish state. So that is your COVID-19, that is your kind of like a mini tech burst because tech had its rally in 2021 and then 2022 they start to like consolidate and then it start to go down because the earnings cannot keep up with their valuation. And then you also notice that in 2008, 2012, those are the times where fund managers are more cautious because that is during a bear market. Now, each time when they are actually over invested, right, they have very little cash pile. And you can see that some of them even took out leverage. You can see this retail net purchase of levered single stock ETF. That is basically your net flow with leverage is actually going up over the past few months. So this is actually a sign of worrisome because things are getting too optimistic or too bullish. And it is actually kind of like overheating the market at the moment. And all of these signs are actually quite worrying in a stock market, and especially when everything is looking very rosy. Now, this is bad. Why this is bad is because there has been a rising credit card delinquency rate. And you can see that consumers are actually getting stretched. They don't really have enough of money or savings to even pay for their goods that they consume. So you can notice that this graph over here, that the credit card delinquency is now at, it's not at its all-time high. Its all-time high is actually in the 2010, which is post-global financial crisis. So that is where the time where, a lot of people lost their pensions, and basically they don't have enough money to buy stuff. So that's why they max out their credit card and they cannot pay off their credit card debt. So now we are at a sign where the credit card delinquency is also going up. You can see that we actually surpassed 2020's COVID-19 crash, which is pretty interesting to see that. And yeah, now it's like these signs are actually pretty very bad, especially when your consumers don't really even have enough income to even buy. And this is also thanks to the stimulus check that they have received over the years. So in 2020, the government actually gave them stimulus check, and which is why a lot of people are relying on this kind of temporary boost in income or cash that they have. And that causes them to actually splurge a lot, revenge spending. And now you can see that once all of this income or cash that they have used up, now they have to rely back on credit card and they don't have enough money to pay off the debt. And this is another shocking stats, which is where the spending spree actually supported by excess saving is over, which means they have dried up their gunpowder. They don't really have enough cash inside their bank. And all this leads to, pile out on credit card debt or even personal loan. And yeah, increasing in delinquency rate. Now, in the US, about 70+% is actually contributed by the personal consumption expenditure. So that reason why is because the US actually you need a lot of it's a service-based economy, and hence you have to rely on these consumer to actually spend. So what if they actually stop spending? So that means businesses cannot really run properly, or they cannot expand. And since they cannot expand, which means revenue and profit will start to trickle down as a result. So all of these signs are actually pointing towards that we have reached an overheated market, where you can see stock market has been going all-time high, but then internally this lagging indicator is not even a leading, it's a lagging indicator, shows that we are in a tight spot, or actually in the US is in a tight spot, not Malaysian so far. So yeah, that is basically in the US side. Everything looks very rosy, but at the same time very dangerous because of all of these orange flags that is happening around in the market. Now, this would then leads us to this prediction whether S&P will continue to rally or it go down. Now, do keep in mind that what is keeping the market going up is because of Nvidia, and also I think there's Apple and Meta. So what if consumer actually stops to even buy, let's say, Apple products, or temporarily stop purchasing, or spending money on advertising on Facebook, and all of these kind of signs. So in order for S&P 500 to actually continue to rally up, there needs to be a boost in terms of the consumer spending. So in this case, it is quite difficult to see that because of all of the stats that we have showed in the previous slide. So the only probability that we can see for S&P 500 to move in the future is probably is going to go down. But that doesn't mean it will 100% happen. Maybe, who knows, maybe it will still continue to rally up before we can even see a downward trend. Unless the government decided to print more money. But in that case, it was also quite detrimental to the economy because you are piling up on the debts. Now, going back to locally. So locally, you can see that the KLCI index has been pretty flat after May. We have this rally on data centers, construction property companies actually made a lot of money. And that is actually backed by numbers because they are selling land, or they are even, they are the first to actually make money. First, because property companies, they are selling the land. Construction companies are actually building the data centers, the malls and whatnot. So they are getting paid first. And which is why the KLCI actually rallied up. Thanks to YTL Power and also YTL Corp, and also Sunway Construction as well. But at these past few weeks, the market has been very, I would say, very quiet. Not much of a movement. Probably also is because the hype of data center is starting to reach at its peak. So there's not much of an excitement going on that can really pump the market. Unless there's another small cap company that announced they decided to do data center. Who knows, right? So far, that has been the case when there's a news that pops out, and then there's this small cap company that announced they want to do data center. The market will get excited. But so far, I think the market has started to becoming more rational at the moment. Now, this is a few orange flags that we actually discovered with our research team. So number one is that the fund managers are stacking up margins. So not only in the US, but also locally in Malaysia as well. And they are actually trying to, catch up and buying all the stocks that actually have rallied up a lot, just because their funds, the managers or the top management want them to buy that kind of particular stock. So they have no choice but to actually take on margin and maybe buy more, and which result them to actually take on margin, because let's say if they finish their cash, the only thing that they can get is actually investing through debt. So this is actually a sign that we are seeing that that's not really that healthy. Once you see that more fund managers are using debt to invest in the stock market. Now, the second point is interesting because you can see that the picture that we have here, which is VTROX. So VTROX recently, or I would say I think it was June, the early of June, posted this picture on their Facebook page. So basically, they say that Nvidia CEO Jensen Huang keynote on the Computer 2024, and VTROX was shown as a player of edge AI and robots in the factory ecosystem. Now, once this picture was announced, right, guess what happened to VTROX share price? It actually rallied up about 23%. And this shows that a picture that can induce stock trading or even encourage more people to buy their stocks, which is very interesting because you rarely see this kind of scenario happen unless you are in 2020, which is during the glove craze, when random companies or small companies decided to venture into glove, and that's what triggered the share price rally. So we are seeing this kind of mirror image again. Back in 2020, or maybe even back in the 2000, which is the dot-com bubble, whenever there is a company that is named .com, that will actually add value to the company the company's valuation, and hence their share price actually rally. So yeah, this is the second orange flag that we are seeing, which is just a mere picture can boost a company share price, which is not really backed by fundamentals. Now, the last point we have here is conversations about AI. Now, this means is that when your hairdresser or maybe in the supermarket, you know, the uncle, auntie who's selling fish or chicken starts to talk to you about SNS network, start to talk to you about VS Tech, right? And whether you are buying any data center or AI stock, that is usually the sign of the pig. Because in the past, you know, in 2020, we also have seen this kind of like similar thing happening where the uncle actually showed a Supermax stock chart when he was selling his chicken. So that I believe there was an image that was shared in Facebook. And we are back to, you know, the same thing is going to be happening this year again. And people are just talking about AI. People who are not even invested in the stock market are talking about AI. So that is actually a very, very funny situation. And it reeks of the 2020s, you know, optimism. Now, all of this actually just to tell you that there's a herd mentality going on. Everybody is just chasing for that few stocks, your data center companies, which I think it is too overcrowded and overheated and over covered also. And yeah, if you want to stay away or you want to stay ahead of the herd, make sure you don't join them because usually the valuations may not be that attractive at the moment unless they manage to deliver a great number and they can actually make more profits and cash flow even after the bull run. So that is actually key. But whether that would happen, it's personally probably is going to be very unlikely. But I could be wrong also, since you know I'm just someone who's just staying on the sideline from this entire DC bull run and also AI bull run. I have not really invested a lot. Personally, I have not really invested a lot of these DC companies, only a few only. And I actually have stopped looking at this particular industry or trend wave because it is just too overcrowded. Now, I want to show you an interesting chart. Do you remember when the investors actually compare between Cathie Wood's and also Warren Buffett's portfolio? So during in the 2021's hype, you know, Tesla was the talks of the world. And Cathie Wood's portfolio actually managed to outpace Warren Buffett's portfolio by a wide margin. I believe that they were making about 100 and plus percent, whereas Warren Buffett, I think was back then was around like 20 to 30%. And if you look at 2023 and 2024's return, you can see that, you know, right now value investing is trumping again. And they actually managed to beat Cathie Wood's ARK Tech portfolio by a wide margin. So Warren Buffett right now is making about 14.28% annualized return, whereas Cathie Wood is making about 6.92%. So what this message is just trying to tell you is, you know, you want to invest carefully. Always need to look at those counters that have the very high margin of safety. And you want to value invest and find companies that is trading at, you know, below a certain multiple. They are making a lot of cash flow. They're paying a lot of dividends. Maybe that is a time for you to actually discover this kind of company at the moment and not just, you know, look for companies that has AI or even looking at expanding to data center, those kind of like stock. So that is just basically my own opinion, and that sums up about this for today's video. And before you guys go, this is our FIRL Pro's portfolio performance. You can see that May 2024, our FIRL Pro, it is up 57%. I believe right now we are up about 60%. So as of this recording, when you're watching this video, it's already up another 3%. Catalyst portfolio is also up 14%. And the Boring portfolio, which we just launched April 2024, it is up 6.56%. Now, what is all of these three portfolio mean is that FIRL Pro is where we showcase our best idea. We also write our report or our analysis on certain companies that we may or may not own. So if we own that particular stock that we research or wrote report about, we will share with you guys, we'll disclose it. And if let's say we exited the company, we also let you know in the FIRL Pro program. And for Catalyst portfolio is basically our best short-term idea. So if there's any catalyst that we have seen for the short term that we think that we need to capitalize on, we will share with our members as well in the Telegram and Facebook group. And last but not least, we have this Boring portfolio. So if you are very conservative and you prefer cash flow, dividends, this portfolio maybe suits you. So you can check out what stocks that we have owned in the boring portfolio in the FIRL Pro program. And if you want to know more insights about FIRL Pro, you want to get a taste of it, you can check out our free sample. It's totally free. You can just check out how we write our reports. I think there's 2 reports. One is KGB and the other one, I believe it is dividend, if I'm not mistaken. But yeah, it is free for you. Just check it out. If you like it, you can sign up for FIRL Pro. And if you don't like it, well, in 10 days, we can actually give you a full refund. So you just need to email us, say that, hey, I think I don't like this FIRL Pro, please give me a refund. We'll refund to you 100%. Maybe we'll just ask you why or the reason behind of it. And yeah, we'll process the refund for you right away. But other than that, hope you guys enjoyed today's video. Stay value invested, and stay educated, and stay informed. See you guys in the next video.